So before BlackRock, I worked on a startup called Infinity Core LLC. We were focused on trying to use field programmable gate arrays to mine digital assets, cryptocurrency. I learned a lot about DeFi in the early days of DeFi and a lot about mining and so forth. When the bubble burst in 2018, our funding disappeared. I had to go get a real job, and that's how I ended up at BlackRock.
Welcome back to the TRU Money Show. I'm your host, Robert Miller, and today we have a great guest. Not only is he an awesome guest because he's knowledgeable about crypto, but he's also the partner in TRU Capital. He's one of the co-founders here, and he's made his way down from New York because he used to work at BlackRock. So if you are very interested in digital assets and you want to see what it's like to not only manage it, know it very deeply, but also understand it from an institutional level, no one can tell you better than my partner, John. So, John, welcome to Miami, but welcome to the TRU Money Show.
Thanks, Robert. It's great to be here.
Yeah, so how was your time in New York compared to Miami? It's way more beautiful now, huh?
It's way more beautiful. The temperature is much more agreeable. But I'm always going to be a New Yorker at heart, so I love New York City, and I'm excited to get back there. But it's going to be good to be here for a while.
Okay, gotcha. Yeah, I know you came down because it's the F1 weekend,
Yes.
and we're actually speaking at an event, right?
Right. Yeah.
That's going to be super fun. So we're speaking to a bunch of high, net worth individuals, accredited investors, family offices, because that's who we serve here at TRU Capital. But largely, it actually came together because John and I knew some people. We've been to these events before, and we decided to go in and sponsor the event. So super excited to be doing that with you, man. It's gonna be great. But for those that don't really know you, because you were working at BlackRock during the time of really the beginning of the show and beginning of building the fund. Why don't you share a little bit more about, what you did over at BlackRock, even before BlackRock, and really just your experience in digital assets, and we'll hop into the episode.
Sure, absolutely. So before BlackRock, I worked on a startup called Infinity Core LLC. We were focused on trying to use field programmable gate arrays to mine digital assets, cryptocurrency. Back then, this was the time when it was the 2017, 2018 bull run. A lot of people thought that the future of digital assets was going to be in forks of the Bitcoin blockchain. So you had a lot of things like Bitcoin Cash, Bitcoin Gold, Bitcoin HV, Litecoin, things like this.
They're quite private.
Yeah, exactly. There was tons of these things. And at the time, ASIC miners, so ASIC is the term that's used for most Bitcoin miners, and it stands for Application Specific Integrated Circuit. What that means is a specific purpose-built computer that's really good at doing one specific thing, but almost useless for anything else. And so if you had all these different forks that were going to be using different kinds of consensus algorithms, you would need different application-specific integrated circuits to optimally mine on whatever that was. So the idea of using FPGAs, field programmable gate arrays, was that they were highly customizable. So you wouldn't have to throw out your computing hardware and completely buy a new piece of hardware every time you wanted to switch what you were mining. So we had some interest on that. I learned a lot from that. I learned a lot about DeFi in the early days of DeFi, and a lot about mining and so forth. But ultimately, when the bubble burst in 2018, our funding disappeared. I had to go get a real job, which I like to joke. And that's how I ended up at BlackRock. I was interviewing a few different places, found the job there. I was on the Aladdin platform. So I spent 6 years there. I started as an analyst, senior analyst, associate vice president for the last 3 years I was there. And I was on the Aladdin platform working primarily in client services and relationship management. So I got a lot of experience in dealing directly with our clients, our users, understanding their workflows, processes. And I was primarily in the front office space. So working with a lot of the biggest portfolio managers, traders, risk officers on Wall Street. And then my job was in training and supporting a large staff in New York and other offices in North America, to just really deliver the service that our clients needed to leverage that technology. There's, I think, now upwards of $30 trillion of assets under management on the Aladdin platform. So it was a great place to learn. While I was there, I still had this passion for crypto and digital assets, and the market started to come back. And BlackRock at the time had a very small team in the digital assets strategy team and the digital assets lab, which eventually materialized afterwards. And so I got a lot of great learning opportunities working with those people. Got to know them first name basis, very personal. I got to represent BlackRock at a couple of different crypto conferences. And when you come to a crypto event from BlackRock, you get a different level of treatment and a different level of exposure. But to me, the big benefit was a different level of education, because I got to meet a lot of the people who are founding these projects, what they were working on, what they saw as the long-term vision for the project. Who's your competitor? What's success look like? What's the long-term roadmap?
Mhm.
So I just learned an enormous amount of information, both about digital assets and about finance in general at BlackRock. So it was a great way to kind of lay a foundation in crypto and digital assets and in finance in general, institutional level finance and relationship management. And that kind of led naturally, I think, into TRU Capital and being a founding partner and a head of research here. So that's kind of been a little bit of my journey and story there. And the real core passion is with digital assets for me, but that's sort of the story there.
For sure, yeah. I mean, great recap of about 8 or 9 years. You had digital assets. There's a lot that's changed. Obviously, when you're looking at forks, for those that don't know, it's basically when you had one chain, so let's say Bitcoin, um, people not agreeing on what the rules of that blockchain should be, since it's a community-driven thing. And so people had different ideas of what would be needed to help grow the network or scale the network or whatever the case is. And so breaking off of those blockchain rules is called a fork. So if, for example, Bitcoin private wanted to fork off of Bitcoin, it would use all the same blocks, but then going forward, it would be private with this kind of consensus. And there was a bunch of that were coming out. So that's a big flashback to 2015. We're obviously not having fork conversations now. We're having more conversations about institutional adoption. We're seeing what the institutions are actually doing to speed up the adoption of the globe really into this type of ecosystem. And that's what we're going to be talking about here today, which is more about real world assets. And so we are big proponents on the RWA sector. There's a lot of new tokens that are coming out, new projects that are coming out, and there's kind of a buzz around what that even really means. And I've had the pleasure not only to work behind the scenes with some of these projects from actually tokenizing some of my assets, but also from the crypto investor side, kind of how that works. So we have a unique advantage and understanding of this because we've played on both sides, and John has extensive research on this, especially coming from BlackRock, and BlackRock's very heavily involved. And so let's kind of shift the gears a little bit more towards, what is a real world asset? What does that even mean? How does that apply? And then we'll kind of dive into what that really means for the future of digital assets.
Sure. So real world asset really just refers to an asset as we would think of it normally, right? So it could be a deed to a car, or title to a car, a deed to a house, real estate things. It could be tokenized equities, ownership of a stock, or a bond. Anything that you can, have in the real world as an asset can be tokenized and placed on a blockchain rail. So that's where the term comes from. I think as this industry evolves and matures, the term real world asset will no longer really apply and will just be thought of as assets in the same way that, in the old days, bonds used to have coupons, literal physical coupons on the bottom you could tear off and go turn at the bank to get your payment on the bond. We didn't stop calling them bonds just when they or stocks when they converted from paper to digital.
Hmm.
When we convert them from digital to tokenized, it's still going to be the same asset. So, but it's just like a way for people to think about this, right? So, um, in the traditional Web3 space, everything is code, right? It's all zeros and ones. But the real world asset thing just applies to things that we traditionally think of as assets in the traditional marketplace. So yeah, I think that's kind of what that is. And if that's not clear, we can maybe go in a little more detail on that. But the future of this, I think, is that a lot of major institutions and specifically leaders of major institutions, which I think is an important thing not to get lost, right? Like the heads of a lot of major firms have openly said many times, publicly and privately, that they believe the tokenization of assets is the future of global finance. So that means for real estate, for stocks and equities, for bonds, for derivatives, for all these different markets, commodities. All of these things can be moved to a tokenized version of themselves and then settled on blockchain rails, and that unlocks a number of benefits for all stakeholders, which we can go into more. But that's kind of what real world assets and tokenization refers to.
For sure. And, yeah, I'm glad that you kind of did a high level overview because there's a lot of moving pieces when it comes to RWAs specifically. And so let's kind of take each piece chunk by chunk. So he just talked about that RWAs is really just a way to conceptualize really what the assets that we have now that are traditional and older rather, and bringing them online, bringing them on chain as it's called. And so one of the major perks yeah, of the tokenized side is just having real ownership or the ability to have real ownership. So when you buy a stock now, you don't actually own the stock, which I'm sure many of you investors know. Or for those that don't know and maybe just had a Robinhood account or a Schwab account and just, open it up and buy the index, you don't actually own the stock. You own an IOU of the stock. The institution holds it into a pool of the actual stocks themselves, which then have to go through the DTCC to move that stock from one hand to the other hand. Usually that's institution to institution, and then they take that layer and drop it down to you. And so when you tokenize that, you actually get rid of a lot of that overhead, and there's compression and the ability to move collateral. So really the online wallets that we have in blockchain, whether that be an app or whether that be like a little Trezor device or a Ledger device, imagine that holding your stock. So like that key, the private keys to that, blockchain, owning that stock is valuable. Similar to a login to a Charles Schwab account. Like that's valuable because then you could transfer it and move it everywhere. But with a traditional brokerage account, again, you have the 0 plus 2 days, 3 days, or even 1 day for settlement. And as we move in a faster transacting world, that compression is really what matters for the RWA technology. That's really what it's all about. And instead of having all this paper issuance and documentation, it can all be done in a blockchain. So it simplifies things for institutions to manage it and track it. And it gives benefits to the actual owners of it. And that's really the idea behind bringing RWAs on chain. Now, whether or not that we actually get to own the assets, if they're held with BlackRock or if they're held with Fidelity, is a totally different conversation. But that's what the technology kind of enables us to do. And so to add to that, I know BlackRock's heavily involved and other institutions are. So why don't we talk about some of the initiatives that they have underway
Sure.
around
Yeah,
that?
we could do that. So I want to just like drill down on some of those benefits and make sure that that's a little bit more clear before we go into like some of the specific things that firms are doing around this. Because the compression that you're talking about gives a number of benefits, and there are benefits to every stakeholder in the ecosystem, right? Not just the end user or the client or the issuer or the asset manager, whoever it is, but it's benefits to everybody. So the first one is that it's more efficient. Um, it doesn't take, T plus one to settle anymore. It can be done much more quickly. It's immediately verifiable. You're talking about like, with Ethereum, which is slow by blockchain standards, 10 seconds tops to get finality as opposed to waiting a whole day. And then there's a lot less expenses involved in terms of collateral that you have to lock up with these clearinghouses while you're waiting for all these transactions to settle. So there's just like ample benefits in all ways. And then another element of this as well is that if you are, settling things on tokenized rails and you are part of a large public blockchain infrastructure solution to do this, then a lot of these different, financial institutions do not have to keep, maintain, update, and maintain compliance for their own infrastructure. You get the benefit of engaging with public infrastructure. So that means that the marginal cost of doing business goes down in expense, and so it scales much more better. Then the another benefit of all these things that's not currently offered is the innovation that comes from tapping into that public blockchain pool and moving things on tokenized rails on a public blockchain. Is that as continued innovation happens, you're gonna be able to participate and reap the benefits of that. So it's not only like more efficient, more secure, more scalable, it gives you access to innovation to participate in innovations that will bring about future improvements for the participants in this financial ecosystem. So all that's kind of like general benefits that come from this. There are a lot of people doing a lot of activity with this right now. So Broadridge is doing a lot of volume on something called the Canton Network, which is we can go into more detail about that. Franklin Templeton was one of the first people to tokenize a security, the Benji token. So they have that on. They started that on the Stellar Lumens network, but they've expanded that to other networks as well. Public blockchains. Biddle from BlackRock is one of the ones that's gotten the most attention in terms of like a tokenized real world asset on chain. That was launched on Ethereum and is also bridged out into other public blockchain ecosystems. So these are, some major institutions, and there's a lot of other ones like Fidelity's doing these things. A lot of other institutions doing this as well, money managers, asset managers. But the benefits are there, and so everybody's trying to explore this. Right now, what we're seeing is mostly like advanced proof of concept, right? Like I think these things are not what you would call just like proof of concept exactly, but in the finance world in Wall Street terms, they kind of are. They're the most basic version of a financial product that they can bring on chain to establish trust, establish, adoption in market, product market fit, and then from there see where the demand grows and where it goes. Because like speaking from my experience at BlackRock, it's key not to like front run client demand, right? There's enough business going on to where they don't have to go out, build a new product, and try to beg people to use it. It's more about saying, like, okay, let's get close with our clients, understand their needs, understand what their concerns are, what their benefits are, and where can we create an offering that, you know, fits within compliance and KYC, which is always the first concern for a major financial institution, but then also unlocks some of these benefits and allows them to participate in some of these things that are changing the way we're going to do finance for the next 100 years.
For sure. And so when people hear this, at first it's like, okay, that's the new fad in crypto, right? There's plenty of fads, memes, and all this other stuff. But what does it actually mean for, you know, individuals or even for family offices that are like, hey, I have all of this money. Cool. RWAs are happening. It might, reduce some of my costs in holding this stuff. But what does that actually mean to me? Is it just a better compression in costs? Is it cool? Now I'll have a better way to manage my assets instead of having to have all these brokers in place. Like, where do you see that integration coming? And without name dropping any projects, because I know that we're allocated to some as well. Where do you see RWAs applying specifically for people that have really a lot of money that it's going to go through this transition, whether they like it or not? They just want to be prepared for it.
Sure. Uh, to be honest, I think there's a lot of different ways you can think about this because although it's clear that a lot of major financial institutions are going to move in the direction of tokenization, it's not clear yet where a lot of the value from that movement is going to accrue and where, from an investment perspective, you'd want to be allocated in order to capture that. So I think right now, hedging the possibility of missing that upside or not participating in that is maybe the most rational approach. So just making sure that you have exposure to a lot of these um, public blockchain infrastructures that are likely to get a lot of adoption and traction from this. However, like you said, like these firms are going to make this transition kind of with or without the participation of their clients, and it's not something you really need to know that much about, right? Like if you're buying and selling stocks, you don't necessarily care if it's going through a clearinghouse or selling on a public blockchain or a tokenized version of it, as long as you're getting, a great product, a reduced fee, and quicker solution. Like you don't necessarily need to pay attention to that. But the way that some of these firms might implement these solutions might make material difference to you because they might end up with ever increasing control over the assets that are being exchanged and the capital that's changing hands. And if that matters to you, then that's something to pay attention to as well. So I'd say, like, in general, you just want to hedge out the risk of missing this or just being ignorant of it. So like pay attention, get educated, and then just I'd say, yeah, see where the football goes on this, and watch carefully which institutions are pushing for which kinds of solutions, because not all of them are created equal and they have material trade-offs. I'll give you a couple examples of what I'm talking about. So a lot of the asset management firms, so like the Franklin Templetons, the BlackRocks, the Fidelities, these people are more inclined to move towards public blockchain infrastructure. And I think that that's generally the consensus on Wall Street, is that public blockchain infrastructure gives access to deeper liquidity and access to more overall benefits for all stakeholders. And so that's the direction of travel that they're going. A lot of other institutions, let's say more banking side of things, that have many dozens of trillions of dollars of assets under custody, want to keep those assets under custody. So they are launching either highly permissioned or semi-permissioned blockchain infrastructure that they leverage most of the majority of control over themselves, such that whatever assets are issued on that chain, they have total control over who can transact with who gets, whitelisted, who doesn't pass KYC AML requirements. And so by doing that and trying to force a lot more activity onto their own siloed permission chain, they retain or even in some cases expand their control over the economic activity that's happening with these assets and the capital and the behavior of their clients at the end of the day, if they really wanted to exert that power. Not that they necessarily would. But those are not identical solutions, right? And they have material trade-offs in terms of property rights, control, autonomy, um, uh, financial liberty, right? So I think not necessarily saying which one is going to win or should win, but I think that if a person cares about that, I mean, I have my own opinions about that, obviously. But if a person cares about that kind of thing, about whether or not they have true ownership over their assets, I think those are things to pay attention to and to voice an opinion about, right? To like let people know if they're pushing you towards a solution that you don't approve of in terms of a tokenization solution, to advocate for a different one, to educate yourself about what those alternatives might be, and try to steer the ship in that direction.
For sure, for sure. And like you said, tokenization is so broad. So each institution is going to approach it different.
Yes.
You may approach it different for your family office. You may approach it differently, even just for yourself. And when people hear tokenization, the next thing to think of is like you have instant ownership, or you have now that party risk, that central point of failure of you having all your assets and they can all go away. So you want that third party custody. So as John was explaining, like different institutions are going to have different incentives for holding those assets. But I think one thing that is very interesting that isn't talked about enough is ADRs. And that's kind of starting to happen as a bridge in different markets. But I think RWAs may take that over, which is a depository receipt. So if you're not aware, you can have, let's say, $1 million in Asia, US dollars in Asia. Then you want to bring that to American markets. You can get a depository receipt, and then they can give you a credit of either that million or however you actually do deposit. But you can get a portion of that or all of that into a Charles Schwab account here. That way you can be active and you have the depository receipt be a claim to the broker. RWAs can fix those kind of inefficiencies and those kind of certifications and processes that take 7 to 10 days. So although here in the United States, RWAs, may or may not seem like the hot thing, there's a lot of obviously attention on this sector. This is a big deal for the globe because not a lot of places in the globe are they able to come onshore to US markets without all of this complexity. One of the projects that we know very well, they've launched a global markets product specifically to help with this issue. So I think tokenization is not necessarily here to bring more liquidity, but to provide easier access, and the liquidity is going to follow whether or not that equity is doing good, those bonds are doing good. So I think it just actually creates more dominance in the U.S.'s position or in other countries as well to allow their stock offerings and their tokenizations to the world, which is a really big deal because we're going to be global. Get it? Or so.
Absolutely. I think another important thing to highlight about that is that the current administration has thrown the bulk of their primary legislative agenda focus around this exact issue, trying to bring clarity around stablecoin legislation and market structure for digital assets. A lot of that has to do, I mean, stablecoins is a tokenized version of the dollar. So, like, that's a real world asset example, right? Of tokenized real world asset. That's the primary legislative agenda right now of the Trump administration, and also it's the primary focus of the Treasury Department. The Secretary of Treasury said about a month ago, we are going to maintain the dollar's dominance as the global reserve asset, and we are going to use stablecoins to do it. So the legislation that's going to come into place is going to create a lot more clarity in terms of definitions of what these things are and what they are not, and who regulates them, and how to conduct business using them in a compliant way in the United States jurisdiction and globally. So once that kind of happens, I think you're going to see uh, that's the biggest choke point right now that this industry is facing in terms of the proliferation of real world assets. Once that jurisdictional clarity comes and regulatory clarity comes, it's going to be interesting to see the speed at which this Cambrian explosion of real world assets happens. But then also, what I'm curious about personally is finding out what the next choke point is, because once the regulatory hurdle is gone and Darth Gensler's reign is over, thank God. Finding out what the next hurdle is going to be interesting, because it might be reluctance of clients, it might be reluctance of issuers, it might be just be like a difficulty of getting the developers to build the things fast enough. But I think that's going to be interesting to see where the next choke point is and how this gets adopted, who adopts it first. If it'll be retail, if it'll be family offices, it'll be institutions, nation states. But I think there's going to be a lot of attention and economic energy that goes into this once that regulatory clarity comes.
Yeah, I love that. I love the second and third order, fourth order thinking. I mean, I actually just had a webinar 2 nights ago literally covering just that. It's like, hey guys, if this is to be true, think about what's next going to happen and next going to happen. So that's just a little bit of a glimpse of how we think here at True Capital. And obviously, the True Money Show, we want to provide you guys value. So hopefully, you got a lot of value out of learning more about RWAs, our mindset around them, and really where this industry may be going over the next few years. But we definitely know it's all coming on chain here over the next decade. So with that said, if you found value, go ahead and like and subscribe. Click below. You can learn more about what it is that we do here at True Capital. I will see you in the next episode.